Hello and welcome everyone to the Value Exchange from Fidelity Digital Assets. My name is Chris Kuiper, Director of Research, and I'm joined by my colleague, Senior Analyst Jack Neureuter, as well as our special guest, Matt Hougan from Bitwise. We'll get to our speakers and guests in just a moment, but first, some of you may be wondering, what is the Value Exchange and who exactly is Fidelity Digital Assets? The Value Exchange is a regular webinar we do at Fidelity Digital Assets where we focus on a topic, usually a topic that we explored in a recently released research paper, which is what we're going to do today. And then we invite an external guest to discuss that topic. Now, I can tell you from a research perspective, conversing with and exchanging ideas and opinions with an outside expert greatly enhances our research process and it sharpens our investment theses. So that's something we're going to do today and something our guest certainly has a lot of experience and knowledge in terms of our topic of Ethereum. Now then, just briefly, what or who is Fidelity Digital Assets? Fidelity Digital Assets is a subsidiary of Fidelity Investments. So we're a separate entity dedicated to the digital asset space. Our primary products and services include custody, or what's known in the space as cold storage of digital assets, as well as an execution platform to serve institutional clients so they can buy, sell, and hold digital assets. Now, I'm not going to go through all the history on this slide, but the point is we've been here a long time. You may not have heard of us. We've been slowly and quietly building, but our history goes back almost a decade now, where we first started exploring Bitcoin and other digital assets. We started mining it, and eventually in 2018, Fidelity Digital Assets was born, and that's where we are today as we've added more and more products and services on top. All right, so first of all, I'd like to introduce our special guest today, Matt Hougan from Bitwise. Matt, could you tell us a little bit about yourself, your journey to this space, and what is Bitwise?
Oh, sure. Absolutely. Thanks for having me on. Really delighted to be here. Fidelity is such an amazing institution. The research you do in crypto is so strong. We benefit from it at Bitwise. I think the entire community benefits from it. Bitwise is a specialist crypto asset manager. We've been in the market for 6 years. We're unique in the space, perhaps for two reasons. The first is we're the largest crypto index fund manager in America. So we created the first crypto index fund and today run the largest amongst a suite of almost 20 products. And the second one is that we're oriented to serve financial advisors and the RIA community. Today, we serve nearly 2,000 financial advisors or RIAs. We do also work with institutions and retail, but that's our orientation. And then last but not least, like Fidelity, we lead with research. So we were fortunate enough to co-author the CFA Institute's first ever guide to Bitcoin, blockchain, and cryptocurrency. And we love educating other financial professionals who aren't focused on crypto 24/7, 365 about what this space is. I came to Bitwise 6 years ago after spending a decade in the ETF space. So I was the CEO of ETF.com and built one of the first ETF ratings and analytics system. I got interested and involved in crypto during that phase because, of course, ETFs and crypto have tried to cross for nearly a decade now. So after I sold that firm, crypto was the natural place to go. And it's been a wonderful transition. I love being here.
Excellent. Yes. And as someone in the research space, I can also attest that you put out some excellent research stuff that we've read and consumed, and I encourage other people to do as well. All right. So to get started, I'm going to take on the role of kind of a moderator, but also joining the discussion. And I'm really going to try to take on this persona of a potential investor on the space who wants to better understand the investment thesis behind Ethereum, or specifically Ether, the token. We'll have time for Q&A at the end, so feel free to put your questions into the Q&A. You can do that throughout this conversation. You can submit them anonymously. The rest of the guests will not see them. Only the panelists will see them, so be sure to do that as well. We'll leave about 10 or 15 minutes for those at the end. All right, so we're going to be talking about a paper that we recently released. Jack Neureuter, our analyst here, he wrote it along with a colleague, Max Waddington, who's also on our team. And it really goes through the investment theses of Ethereum. We go through two main theses here. So one thing I want to point out is we already came out with a paper called Understanding Ethereum. And this is really a primer about the ecosystem, how it works, its history. This is a follow-up to that. So this is going deeper on the investment side, right? So we're going to try not to get technical or anything like that. But if you're wondering a little bit more about the basics or about Ethereum, go check out that paper first, and then come and read this other one here. So the main question we want to explore today is, why should I, as an investor, consider buying and holding Ether, the token? But before we dive into that, Matt, I'm going to turn it back to you and take us a step back to start. If I'm an investor, maybe I'm already invested in Bitcoin. How should I look at Ether, the token? Is it mutually exclusive to Bitcoin? Is one better than the other? Should I own both? How do you think about this question to start?
Yeah, first, congrats on owning Bitcoin. That's a big step. And absolutely, you should consider owning both. Just to give the 30-second background, every crypto asset is two things. It's an asset and a blockchain. The blockchain is a piece of software, and that software can be optimized to be good or bad at different things, just like any other software. So the Bitcoin blockchain was the first blockchain. It does amazing things. You can store wealth without a bank. You can send money around the world, but you can't program it to do much. It has a limited programming capability. Now, that has a big benefit. It makes it extraordinarily secure. It's a very simple code base, unlikely to have bugs. Ethereum was developed after Bitcoin, developed in 2015. They looked at Bitcoin, said, it's amazing you can send money around the world. What if we could program this to act like a bank, or program this to act like an investment banker, or program this to act like the New York Stock Exchange? So they took the idea of Bitcoin and they made it infinitely programmable. And what that means is that they're finding two different use cases. Bitcoin is emerging potentially as a form of digital gold, potentially as a means of payment, a monetary asset. And Ethereum is like this global supercomputer. I compare it to the Apple App Store for decentralized applications. It's a global platform that people can build on top of. And today there are over 6,000 apps with hundreds of thousands of daily users. The reason that's important today, you asked, could you own both? Historically, Bitcoin and Ethereum have been pretty highly correlated because the biggest question in crypto has been, will crypto survive? But we've moved past that, and we're moving into the use case phase of crypto, where Bitcoin is really evolving into that monetary use, and Ethereum is evolving into this platform. You're seeing things like PayPal just launched a stable coin on Ethereum. Going forward, I expect the returns to be more different, because the importance of that use case is going to grow as compared to the sort of crypto industry factors. So I think they'll be divergent. I think if you want to be a diversified crypto investor, you need exposure to both. And different investors will find one or the other more appealing. But I really do think they're different crypto assets. They're going to have different returns in the coming months and years.
Yeah, that's an excellent. Oh, go ahead, Jack.
No, sorry, I didn't mean to cut you off, but I was just going to add to sort of what Matt was saying there, which is this whole idea of still today, we look at crypto as being one singular bucket largely, or traditional allocators look at crypto and then they see Bitcoin, they see Ethereum, and they see other more speculative things, but they throw it all into sort of one crypto bucket, and then they allocate within that bucket of Bitcoin versus Ethereum, right? And so naturally it gets pitted up against each other, when in reality, like Matt's sort of alluding to, if you dig underneath the surface, like in Vitalik's white paper in 2014, he acknowledges like Bitcoin has created this really cool innovation, but it's designed specifically to be a monetary asset, and it's intentionally very simple. What if we add more functionality of introducing smart contracts on top of it? Like, what other things are possible? And like Matt said, we use it all the time in our research, is this word trade-offs, where there's a complexity and simplicity trade-off, and that informs sort of your use cases. And so again, hopefully we're not going to agree this entire discussion, but like incomplete agreement where not necessarily mutually exclusive in terms of both could be successful, both could fail, or over time, and there are ways that they do compete against each other, one could succeed against the other. So all outcomes are on the table. And to Matt's point, like a diversified know-nothing investor would probably want to own both if they're going to want crypto exposure.
Yeah, excellent starting point from both of you there. So let's take now the fundamental part of Ether, the token. So Matt talked about how there's Bitcoin and Ethereum, the networks. So that's the protocol, right? But then they each have their own native asset. Bitcoin also has the same word. We try to denote it with a little b, but that's the token. And the Ethereum network, thankfully, has a different word, which is Ether, and that's its native token, right? And so a lot of people, as soon as they get some understanding of the Ethereum ecosystem, what Matt was talking about, this programmability, you can program apps, decentralized apps on top of it, they say, okay, that's great. The network may succeed, and you have to use this token to interact on the network. But why, as an investor, would I want to just buy Ether, the token, and sit on it? say buy and hold. Like, why would I not transact with it? Why should I just buy it and hold it? And so that gets to the question of, how does value accrue to the token and therefore the token holders? So Jack, I'll turn this over to you first. Walk us through what is known as tokenomics. How does this work in theory?
Yeah, so one of the things Matt said up front is these are networks and then they have assets, right? So for Ethereum, you have the ETH token or the Ether token, that's the native token. And there's a relationship between the two, and the design of the network necessarily informs some of the value proposition associated with the asset, because you get the use cases and you also get sort of the properties of that token from the design of the network. But they are two separate things. So you could create a really useful network, but if it has poor tokenomics, a poor relationship between the network and the token may not actually be attractive to hold, right? There could be use for the users of the network, but not necessarily the asset owners of the native, protocol's asset. But in Ethereum's case, I think it's really important to note the upgrade that took place in September of last year. It was called the merge. I'm sure many here are familiar with it. And it's when Ethereum moved from proof of work to proof of stake. And that really was a defining moment, one of the largest, or I would argue the largest protocol change for an existing crypto protocol was the merge on Ethereum. And you moved from miners validating transactions to validators or ETH stakers that are staking their tokens and securing the network in exchange for earning transaction fee rewards. And so you built in a relationship where the token became a yield-bearing asset, and the yield is higher if there's more demand for block space. And so now there's basically a flywheel of sorts that exists where ETH as this kind of technology platform exists. And if you're an ETH token holder, you have the optionality to stake that asset to earn a potential yield. And that yield comes from people finding use in the applications on top of the blockchain and being willing to pay fees.
Right. So ideally, you want the two linked. So the more people demand space on the network, which is limited, the more value is going to accrue to this token. And you can see we've got a chart up here where you can see some of this in action. An individual, when they transact on the network, they have to pay a base fee that's just burned. So you can think of that as helping to accrue to the holders of the token, right? Because the supply is getting shrunk. And then they have to pay a tip or a transaction fee to the validators, these people who validate the transactions. And then they're also rewarded some newly minted tokens as well. So Matt, you talked about Bitcoin being digital gold, which is a narrative we hear. We've previously wrote about how Bitcoin is, in our opinion, an aspiring money. And the reason we say that is because it has all these characteristics of good money. And economists and historians have observed this over time, that good money is durable, it's portable, it's divisible, it's verifiable, it's scarce, all of these things, right? And so we said, if you stack that up, Bitcoin could make a very good money. And obviously people are treating it like money. And we've talked about how that use case makes sense. So let's get into the more controversial part of this in the community. Is Ether money, right? It's got some of the same characteristics, but there's some pretty strong opinions as to why it may or may not be another form of money. Matt, how do you look at this? Is Ether money to you?
Yeah, another great question. I would say that discussion previously about the burn mechanism is so important. People still don't understand that. It's a huge breakthrough. My core view is that Ether mostly isn't money. I hedged a little bit there. The one aspect of Ether that sort of breaks from the traditional view of what makes good money is that it's useful. It can be used to pay for these applications, to power these applications. It's a utile commodity. And historically, forms of money that are useful haven't had great staying power. It's been like gold, which is not particularly useful, or other scarce commodities that don't have that same functional utility. We think of Ether in the sense that it can be a store of wealth, more like real estate. It's a functional asset where you can park wealth and may appreciate over time as the value of that asset appreciates, but it's not being used much in day-to-day transactions. And I don't think that that's its primary use case, but I will make two small exceptions. They're corners of the crypto market, which really are denominated in Ether. So if you look at PFP, NFTs, or some other corners of the NFT market, those people are not necessarily transacting back to dollars in their mind. They're paying 50 ETH for this NFT. And that is just the economy that they exist within. And I think that's a small corner. So it is a fraction of use as money. But primarily, I think of it as a useful commodity, more akin to real estate or oil than it is to gold or fiat currencies.
Yeah, you mentioned two things that money fulfills: store of value and means of payment. And we've got two charts from our paper here. The first one shows what you were also talking about, that burn mechanism. So this is the Ethereum supply chain change since the merge. And so the big takeaway here is we've lost a lot of Ether tokens. They've been burned. So even though new tokens are minted, it depends if there's a lot of transaction on the network, you can have a net deflation. So more is getting burned than the amount getting added or created, right? And so we're down all of these Ether tokens, and they've all been burned. So the question is, if you have a shrinking supply, you would think that that would lead to a pretty good store of value. Now, so far, it hasn't, because there's a lot of other factors, right? There's a lot of demand factors. Obviously, it's not operating in a vacuum. So far, we haven't seen that, but that is the argument for why some people think Ether could be a good store of value. The other part of the monetary attribute is means of exchange or payment, right? And the second graph we show is this has been really what's hampered Ether as a means of payment so far. It's these average transaction fees that they are wildly variable and they can spike at a moment's notice. So people who want to transact on the network, they might plan out their transaction, the contract they want to do, and the fee, and then all of a sudden it wildly changes on them. That does not make for a very good medium to transact in, right? And of course, we won't get into this, but there's all kinds of things that the community is focusing on to address these problems. But that's where it currently stands today and what we talk about in the paper. Jack, you previously wrote on valuing Bitcoin as a money. Where do you fall in on this debate of whether Ether is money? And can we apply some of the same demand side models that we did to Bitcoin to Ether?
Yeah, so I'm going to be in agreement with, a lot of what you're saying here. And I would say certainly to those that are like the hardcore ETH users, which as a subset of the total global population, right, is a very small set of people. But to those people, I think they would argue that they view it as a monetary asset or having monetary properties. They use it as a collateral on lending platforms, right? But people, and Matt, this is where like all the analogies or calling it a money versus real estate, it's like, okay, well, real estate's a collateral you can get a loan from, right? And like, So there's all of these, they all kind of mesh, and we're kind of arguing the same thing here, I guess, by saying that it's real estate because there's monetary premiums embedded in real estate, and there's a moneyness and a store of value aspect to real estate. And so maybe it's just parsing which analogy fits it better. Is there moneyness or is it real estate, right? So I think there's a little bit of that, but also relevant to the success of the Ethereum network, I think that people will view ETH as more money-like, right? So if Ethereum becomes the de facto smart contract layer one platform, right? It beats out Solana and Cosmos with app chains. Like, I'm not saying it will or it won't, right? That's a huge question that none of us know the answer to. But if it does and it's very successful, then I think the group of people that view it as having monetary attributes and being money-like will increase. So its success or failure means that it will be viewed more as a money or monetary asset. And then we can also use kind of like the gold or gold and silver analogy, where gold has an industrial application, but it's primarily viewed as a monetary asset. And silver has a monetary attribute to it, and some people save in it as money and a store of value, but it's primarily viewed as an industrial application or an industrial asset. And I think there's a little bit of that with Bitcoin and Ethereum, where they do overlap and they do compete for the same subset of money and users in some cases, but they also have their differentiated use case and users and holders. From the specific modeling standpoint, we did use a model within our valuing Bitcoin piece that we wrote, where we said, well, Bitcoin doesn't have this cash flow tokenomics to it. So how would we think about valuing it? And it is very speculative. But if we think of Bitcoin as a monetary asset, its price is set at the intersection of supply and demand. We know it's fixed inelastic supply curve. So what about its demand curve? And is there a relationship, and there appears to be somewhat of a relationship, between more users or a growing network and the price or the value associated with Bitcoin. And then we did the same thing for this Ethereum paper to view it through like a relative moneyness lens. And we found that the relationship appeared stronger. And again, it depends on what time frame you cut. And this is not a perfect or exact science. There's a lot of issues you could take with it. But the relationship appeared stronger with Bitcoin than it did with Ethereum. And that ultimately didn't surprise us, because we do think of Bitcoin as being more of this monetary asset, Ethereum more as this technology platform.
Yeah, great points there. So I think we're kind of settling on the same narrative that there's moneyness in different assets. This is something we see in traditional finance. So this shouldn't be that big of a surprise to use that same lens here, whether it's silver or gold or real estate, or, I'll throw another one into the mix. People like to call it digital oil, something that has a lot of use. You use it on the network, but it can also really go up in price when people need it and demand it. So there's another one to put in the hat. But we'll move on now from the whole money aspect to the second thesis that we talk about in the paper, which is Ether, the token, is now yield bearing. So Jack, you mentioned the big change that made it yield bearing. For our listeners, just to back up on the basics of this. So if you're familiar with the Bitcoin network, it has to come to a consensus and be secured by something. And that's what they call proof of work, right? So it's these miners doing computations and expending electricity. And by expending electricity, that aligns the incentives to keep it secure and keep out bad actors, right? Ethereum started that way. It was the exact same consensus mechanism, proof of work. Then they switched to proof of stake. So just like Bitcoin has a capital cost of mining equipment, computer equipment, and electricity, Ethereum also has a capital cost, but it's even more direct. It's literally the cost of locking up Ether tokens. You have to post them, what they call stake it. And then for this, they're offered a yield on that to incentivize them to do that. And people who have their tokens staked, in order to keep the network secure and try to align incentives to prevent malicious actors, if somebody does something bad, then they get part of that stake slashed, is what they call it, or destroyed or removed, or they can get kicked off the network. So that's kind of the basics here. So Matt, let me turn to you. There's an old adage in poker that says, if you can't spot the sucker at the table, it's you. Similarly, there's those in finance who say, if you can't find where the yield is coming from, the yield is you. So where does the yield come from in Ethereum network, and who's paying for it, and how should we think about it?
Absolutely. Wow. What a tremendous saying. The answer to that is the users are paying for it. As you mentioned, you have to make it somewhat costly to secure the network and process transactions in an honest way in order for a blockchain to work. Otherwise, you get spammed with fake transactions. People are always trying to scam it. So in Bitcoin's case, you do that by forcing people to have sophisticated computers and burn energy. And Ethereum, you stake it. The place the yield comes from is all of the people who want to do things on the Ethereum network. They want to use this network to process DeFi transactions, to issue NFTs, to issue stable coins, to engage in other smart contract activities, to send Ether from one person to another. They need to pay someone to do that. In the traditional world, you would pay a bank, or you would pay a cloud computing service. In the crypto world, you pay the network. And so the place the yield is coming from is all the people who want to do transactions on the network. Oh, wow. Sorry. I'll work on my lighting here. But that's the short answer. Maybe Jack can pick it up.
Yeah, just to pick it up from there, Matt, while you fix your lighting there. The thing I would say is, like, carrying that analogy forward, so many of the largest companies in the US and your index funds that a lot of people listening probably hold are technology companies, and they're just software platforms, and they have a shareholder governance mechanism that's very straightforward and centralized, right? The more shares you own, the more governance you have over the company. And social media platforms are just a piece of technology, and there's network effects around them and certain specific use cases, or like ride sharing applications. It's a piece of technology. There are drivers and there are riders, and then there's network effects, and there's two companies, right? So it's an oligopoly effectively. And the same thing can be carried here. It's just the governance process is a little bit different. It's tokens instead of equity ownership, but the cash flows associated with demand for block space flow down, and ultimately a portion of them are burned, like we were talking about. That's kind of like a share buyback. It's automated, it's algorithmic and automatically happening, but a portion of those cash flows or fees automatically force less ETH to exist, right? And if there's more burning going on than there is issuance, you actually get a net reduction like we had showed previously, which we've seen since the merge when you reduced issuance. And then the other portion is paid down to stakers. And if you own ETH, you have that optionality to stake. And so it's quite clear that it's basically just a distributed business or platform. And so the tokenomics are kind of clear there.
That's right. Yeah, no, that's exactly right. The easy way for people to think of it is stock buybacks and dividends. And it's very similar to that, just on a distributed network. And I will say that when I speak to financial professionals, this fact that you have stock buybacks and dividends or something close to that, something approximating that, makes ETH resonate with them in a way that even Bitcoin doesn't. They find it easier to get their head around this new network than they do something that's not a cash flow producing asset like Bitcoin.
Yeah, and this gets exactly to both of your points, especially you, Matt, at the beginning, of two different use cases, right? And I'm actually glad, for a number of reasons, but glad Ethereum went through its change to this because it highlights this even more, right? Bitcoin, you've got simple, almost commodity-like digital gold. Maybe it's emerging as a money, no cash flows. It's completely scarce. We know exactly how many Bitcoin there are at all times and how many there will be in the future, 100 years from now. And then Ethereum has completely differentiated itself as this more traditional finance corporate kind of thing where you've got, these great analogies that you're using here of stock buybacks and dividends. And that just, you need a totally different framework of looking at it then, right? We also have more of a variable supply, just like shares. We don't know exactly how many Ether tokens will be in the future. People would argue it's still scarce because it's not just going to release an infinite amount at a moment's notice. There's governing mechanisms for that. We won't get into all the specifics and technicals of that, but it really just shows the differences between these two things. And that gets to your point of different use cases and they're not mutually exclusive. So I just wanted to highlight that there. Jack, I don't know if you had something else on this yet.
Yeah, the only other thing I think maybe worth adding here as well is we've talked a lot about the Bitcoin versus ETH, but if we look at ETH versus other proof of stake networks, one thing that you'll notice if you dig into it is that ETH has the deflationary element that thus far, even if you're holding the asset and you're not staking, there is an opportunity cost, of course, if you could stake and you're not staking, but you're actually not getting diluted. If you're holding an asset for almost every other proof of stake network, there's so much issuance going on and some of them don't have burns or some of them do, but the burn doesn't outweigh the issuance. You are getting diluted by not staking. And so what you actually have here is basically like sustainable positive cash flows. And so it's basically like a profitable business already. That's a growthy, profitable business, distributed technology, whatever we want to call it. Like the technical term of business, of course, means something to the SEC and others, but it's a cash flowing, like positive cash flowing machine. And a lot of the other layer one networks don't have enough users paying fees on them that they're actually like net cash burning. Basically, they're issuing supply to create a bootstrapping mechanism for security that Ethereum doesn't really have to be doing.
Yeah. And this, of course, leads into all these analogies with the traditional finance world. We can now start applying some of the same terms and tools and things on this network as we do with traditional finance and securities, or not securities, but instruments, things like PE ratios, all that kind of stuff. One of the ones we did in the paper is say, okay, if this is now cash flowing, let's go back to Finance 101, where every financial instrument's value is derived from its future cash flows. And we get back to the good old discounted cash flow analysis. So Jack, walk us through the DCF model you created. And, full disclaimer, this is just a model. It's not a prediction of price or anything like that. It's purely meant to show that you can construct this. And here are the inputs, here are the outputs. But of course, everything is highly dependent on what you put in terms of what you get out. But walk us through how you thought about looking at the Ether token from a traditional finance standpoint and a discounted cash flow model.
Yeah, so like you said, this was far more intended to be a thought exercise, but when you put it out, that everybody reading it is going to look at the numbers and try to take things super literally. But yeah, what we did was we basically said, okay, well, fees, if we want to keep it really simple, ultimately fees are the driving cash flow. And a portion of those buy back ETH, like we said, there's issuance that goes to those that are that are staking as well. But ultimately, if we want to simplify it, it's really just fees are flowing down as the primary cash flow. And so we can look back historically at fees, and you had an important upgrade that we went back to in time called EIP 1559. This actually introduced the burning mechanism, and it also changed sort of the algorithm or the way that fees are charged, or that fees are determined in each upcoming block. And so we looked back and we said, okay, let's just normalize the average since this meaningful upgrade. And we'll take that average on an annualized basis, and we'll say that that is 1 year's worth of fees. Of course, a bear market and a bull market, these are all going to change the different levers of what those fees will look like. But then we said, well, we already know the price of ETH. Let's just back out the modeled assumptions that are here. And so at the time when we were writing it, ETH was somewhere between $1,900 a token and $2,000. So we backed intentionally into a price that looked roughly around what the price of ETH was at the time. And then we could look at all of the assumptions we were making around the growth of those fees and cash flows and the discount rate that we were using. And we could back into ultimately like a discounted cash flow model that was looking at the value of those cash flows, determining the price of the asset, and then say that, okay, well, if fees continue to grow, or if they grow at a higher rate, well, then the value is expected value, or the present value is higher, right? And so there's all of these assumptions, and it's really important to note, like you could look at the gradient here of terminal growth rate and discount rate. And of course, terminal growth rate is the assumed rate at which the protocol's fees would grow forever. And the discount rate is the cost of money, the opportunity cost that we're associating with making this investment. And if you have a higher discount rate or you have a lower growth rate, it's going to drastically impact the output of the model. And so it's really important to note that. But at the same time, it's a worthwhile thought exercise, I think.
Yeah, I would just add on, we use a similar framework here at Bitwise with slightly different assumptions, but there's some really important things here. I agree it's just a model, but just to call out a few things that may be non-obvious, the annualized network fees are not a model. That is what Ethereum is generating right now. It is real revenue measured in the billions of dollars. And that is growing over time. Yes, it's cyclical, but it's growing over time. It's important to note that is distinctly real. And then the question is, how much do you expect it to grow in the future, and what is that discount rate? And in this sense, from my perspective, Ethereum is difficult to model because it's a little bit like a Series A SaaS startup. It's going after an enormous market, but it's very early in its growth period. So, if you could assume anywhere in this red to green spectrum could be completely reasonable at this moment, depending on what you think. But that doesn't mean it's not an effective modeling tool. I think it's absolutely appropriate. I think you can apply this DCF into a revenue generating asset like Ethereum.
And it's arguably most useful just to know that relation, like be able to look at that model and say the relationship exists, right? In theory, fair value should be determined by the future cash flows that you can achieve by staking and holding the asset.
Yeah, I just one more thing. I know we need to move on. That's exactly right, Jack. And I would expect over time this to be a more important driver of Ethereum's day-to-day price, right? Right now, there's still sort of existential questions. As it matures into its use case, you're going to see this revenue be reflected more concretely in the value that is ascribed to Ether on a day-to-day basis.
Yeah, excellent points. And to your point, Matt, about how things are compressed to, startup, one of the things I've heard that is, because these tokens trade on exchanges, people think of them like traditional things that trade on the New York Stock Exchange or NASDAQ, for example. But you got to keep in mind, it's like they're doing their IPO if they list on an exchange, but they're also still at a seed stage, Series A, B, C, all these things in one. And so the fact that they're trading doesn't mean that they're so far along like the traditional financial markets, especially nowadays when we see companies wait longer and longer and longer to go public. So by the time they're trading in public, they're a well-established company. So just a note, and this will get to our next point on risk, but just a note that these are still early stage kind of things for investors. All right, so let's end with risks here before we get to Q&A. Matt, let's go to you first. Every good investor always needs to consider risks. And in addition to all the regular financial investing risks that we should always be doing, digital assets, and especially Ethereum, have very unique risks that aren't found in the traditional investing world. So let's maybe focus more on those. In your opinion, what are the specific or more important risks investors need to be aware of when considering potentially investing in the Ether token?
Yeah, there are a number. How much time do we have? There are a lot of risks in this space. I'd actually call it the biggest one is behavioral risk. You just mentioned that these are early stage entities trading on exchange where you experience the volatility on a tick by tick basis. One of the biggest risks in investing in any crypto asset, but certainly in Ethereum, is that you're taking on a 24/7, 365 priced, extremely volatile asset. And so you have to think about behavioral risk, and that goes to position sizing, and time duration. That's not specific to the protocol, but it's specific to you as an investor. And I see more people get hung up on behavioral mistakes than on these other risks. But there are other risks. There's a big regulatory risk around Ethereum, whereas the SEC has clearly denoted that Bitcoin is not a security. There is some measure of debate in the Ethereum space, although I would argue a significant amount of evidence on the side of it not being a security. But many of the applications that are built on top of Ethereum operate in an unclear regulatory zone. So there's regulatory risk there. There's, of course, competitive risk. Jack mentioned Ether or Ethereum is not the only layer one solution. There's questions about, could it be outcompeted by other layer one solutions in the future? That may seem far-fetched now if you're inside crypto, but those of us who have been around technology for a while remember MySpace and remember AOL and CompuServe and Yahoo. It's not always the case that the early leader dominates over the long term. There are, of course, technical risks as well. Ethereum is unlike Bitcoin in that it evolves over time. We talked about the merge. We talked about EIP 1599. Those were huge upgrades of software on a live network storing hundreds of billions of dollars. There is meaningful risk in that. And Ethereum will have to continue to evolve if it wants to stay competitive in this marketplace. So those are risks as well. And the last one mentioned here, value accrual risk, I think is important also, of course. We talked about these analogies to stock buybacks and to dividends, but of course they aren't stock buybacks and they aren't dividends. These are just helpful sort of conventions to describe what's going on. But crypto is a new asset class. We don't exactly know how this will play out in the future. We don't know if the Ethereum blockchain will change the mix of who gets rewarded with transaction fees over time. This is certainly a risky investment, a very exciting investment, but these are among the risks we think about a lot at Bitwise.
Yeah, that's an excellent overview of all those risks. The technical risk is one we specifically focus a lot of our time on the research side, because that's these developer calls we're listening to and the roadmap that's changing. And we've also got some new pieces that are going to be coming out that really highlight how things change or improve in the Ethereum ecosystem, but then they have downstream effects where then something else kind of crops up, right? And I'm not saying that's a bad thing necessarily. I'm just saying it's something for investors to be aware of. Like you said, Matt, it's going to have to keep changing. It's not like they just want to keep adding features. I personally think that they kind of have to keep doing this to address the problems that keep kind of recurring or the ones that they see down the road that they're going to have to deal with. So that's a big one that we focus on as well. All right, let's go to Q&A because I see a lot of great questions coming in. I believe, Steve, you've got some that you can read off to us. Speaking of competitive risk, I see some questions dealing with that. Otherwise, I'm happy to read them as well. I think I can see them here. Steve, yeah. Just let me know what works for you.
I got you, Chris. As you said, there are a lot of questions. We may have to do a follow-up for the group here and put some answers in writing. We certainly won't get to them. So I'll try and highlight some here for you. So I think first worth answering here are, what are the largest or best competing assets or technologies that compete against Ethereum? And there was a similar question around would you consider Polygon or Solana and so on to be the same as Ethereum? So in that vein, around similar protocols and competitors.
Jack, you want to take that?
Yeah, I mean, I can start, which is simply to say that prior to Ethereum, with Bitcoin, you had a lot of things that forked Bitcoin and they didn't really add any new use cases. And so the network effects never really stuck. With Ethereum, you actually had something new that was created with introducing the smart contract and making trade-offs, right? And designing new potential use cases with applications on top of it. And since then, you've had others that have made other design trade-offs or tried to kind of do what Ethereum is doing in different ways. And so right now you do have a kind of emerging competitive landscape. And Ethereum is defending itself by, and we didn't even get to layer twos, which Matt, I know you're super passionate about. But at the moment, like Ethereum, Chris had highlighted, has issues with fee spikes, right? Where it becomes uneconomical for a lot of users to use the network. And if Ethereum really is going to be successful, there's going to be a lot more transactions happening on top of it than there are now. And we need a way to scale it. And so one of the biggest reasons why there's a number of competitors for Ethereum has to do with scalability. And you have networks like Solana, for instance, that make a trade-off, and they become, I would argue, more centralized, but they're able to offer lower fees. Because if we're able to run all of our hardware on third-party hosting services and we have a lower number of node operators, then we can make transactions quicker, right? We can confirm transactions a lot faster, and therefore fees can be a lot lower. So you have something like Solana with what we would call like a monolithic design. You have alternative networks like Cosmos, for instance, or this idea of app chains, Celestia, Cosmos, and others that are designing and trying to make for the ability for applications to be able to more specifically design and own the economics of their protocol. So instead of building on top of a network like Ethereum, what if you were your own protocol and then you could interoperate with other applications within an ecosystem? So Cosmos, for instance, very experimental, but you can see how there are different axes in which different layer one networks are competing with Ethereum, but Ethereum is trying to defend itself, and maybe I'll pass this to Matt of how it's trying to defend itself with layer twos and some of the upgrades that are coming as well.
Yeah, great overview. And I agree. I don't think it's a wrap. I think Ethereum is likely to be the dominant layer one, but I don't think it's guaranteed that that will be the case. You mentioned Solana coming in just 2 weeks ago. Visa announced it was doing a payments application on top of the Solana blockchain. And when you see those sorts of large entities embracing non-Ethereum blockchains, I think it opens your mind to the fact that it's still early. Ethereum may be dominant today, but it's not guaranteed to be dominant in the future. You mentioned layer two solutions. I think that chart you showed on fee spikes was really important. A fee is what you pay to do a transaction on Ethereum. Usually it's relatively low, but during, say, the NFT craziness in 2020, 2021, it occasionally spiked really high, right? You can see those numbers on the right are denominated in dollars. That meant it cost occasionally $225 to do a transaction on the Ethereum network. Now, when we talk about real world use cases, imagine you're an entity from traditional finance looking to, say, tokenize real world assets or build your own NFTs on top of a platform or offer a rewards program. And you're looking in this and saying, my users occasionally will pay $225 to do this de minimis transaction. That's unsustainable, right? It can't be the case if this is going to go mainstream. I actually think this fee spike is sort of what put a pin in the progress crypto was making in 2020, 2021. Layer twos are Ethereum's solution to this. So some blockchains like Solana solve this by being more centralized, easier to do, high throughput. Ethereum has solved it or is solving it through layer twos. The right way to think about layer twos, one analogy I like is like a bar tab. When you go to a bar and you buy a drink, the bartender writes it down. They don't charge your credit card because it costs money. They write down all the orders you have throughout the night. And then at the end of the night, they batch it and settle it with the credit card transaction. That allows you to do lots of transactions for free and then settle them on the main chain. That's what a layer two is. You can do lots of side transactions on a layer two and then batch them and settle them on the main chain. And that's allowed the throughput of Ethereum to increase something like 100 or 1,000-fold if you're optimistic, less if you're not. But I think it is the long-term solution to the scalability problem on Ethereum. I think it's likely to work, but it's not all the way there. Right? Ethereum is not ready to be the world's sole underpinning of how finance works today. It would break. And for that reason, I think it's smart to consider these other blockchains. I think they're interesting design choices.
And for an investor, it obviously makes things more complicated. But for the end users and the impact that the industry as a whole will have, competition is a good thing, right? We'll get a better end product 10 or 20 years from now when we know how this all kind of plays out.
Yeah.
Excellent answers. Steve, what else do we have here?
Sure, a number of questions. An area that I know Jack has covered a bit. What about bridges that allow BTC liquidity to be brought to Ethereum for deployment in DeFi? Or maybe you guys can just talk a little bit about the connection between different protocols and what technology exists there. Could you explain that concept and how you feel about that concept?
Go ahead, Jack.
Yeah, I mean, so kind of a, I guess, open-ended question there. But for specific purposes, like Bitcoin and Ethereum explicitly, like they don't know each other exist, right? Each of these networks is more or less siloed from one another, right? And so you run into effectively interoperability issues in which we rely on centralized exchanges a lot of the time to be able to swap from Bitcoin to Ethereum if we think that like Bitcoin is a better representation of money and we want to store value in it, but we want to go use an application on top of Ethereum. We traditionally have to go through a centralized exchange. I don't know where we want to take this question, but like simply speaking, there are a lot of people trying to solve this issue, but it is one of the most complex issues because this is where we ultimately see a lot of hacks take place, is trying to get one network and another to communicate with one another or interoperate with one another.
Yeah, I would just add the short answer is they don't work great yet. There are always hacks. There are always issues. It seems from an outsider's perspective like it should be a very easy problem to solve. And in fact, it's very technologically complex. And because we're dealing with billions of dollars in assets, if there's any issue in your software, any bug or contract problem, it'll be instantly exploited. And that's indeed what we've seen. There's some creative solutions out there. I think the native bridging solutions are getting better. You're seeing sort of stable coin-like wrapping of assets from firms like 21 Shares that sort of wrap BTC and reissue it on the Ethereum blockchain, collateralized by holdings back at home. I think ultimately this will be solved, but right now it's not solved, right? These are separate networks, as you mentioned, that can't really talk to one another. Hopefully, eventually they will be able to talk to one another, but right now they do it very imperfectly and with significant risk.
Great. Thank you, guys. In the effort of transparency, I also wanted to share a question from an audience participant that it appears is not convinced around Ether and the asset class. Why is this not a Ponzi scheme, particularly when you try to apply discounted cash flow to back into a price? I know you guys touch on DCF within the paper. Could you maybe offer a little bit more context there from an investment thesis standpoint?
Yeah. I mean, I can defend on the DCF side, which is just to say that with a discounted cash flow model, you can pick what X you want to solve for, right? If we know the price, we can back into what are the assumptions that get you to that price. If we want to derive like our own assumptions on the future growth rate of those cash flows, we can certainly make those without looking at the price. And then we can compare our estimation of fair value to the actual value of the token. And so in this case, we just wanted to show, hey, if we use a DCF in this theory, what is the price assuming about the growth of those cash flows into the future? But just because we used it doesn't mean that there's something necessarily wrong with it. We were just solving for X in a different place.
Yeah, and I would say to Matt Hougan's point about where the yield comes from, it comes from users transacting on the network, right? They're willingly paying fees, and those can accrue or eventually get to the token holders, right? So kind of defending against using the P word here, you don't need to assume that capital needs to flow into this for people to benefit. What you're assuming is people are going to want to transact on the network. And that's no different than a lot of network technologies. If someone wants to transact on Uber or Lyft, that's where their value comes from. Ultimately they have to serve people that want to use that network. So I don't see anything incongruent with that, being labeled a Ponzi scheme. It's just a matter of, are people wanting to transact on it, but people are willingly paying these fees, and that's where that's coming from.
I also sorry,
go
Matt,
ahead. Nope.
I was just going to add, I also don't think it's wrong to say that like Bitcoin's use case is clear, Ethereum's use case is a lot of them are more speculative, right? A lot of them require clearer regulatory framework for real world assets to be used on top of Ethereum. And then we can use assets that people care about in DeFi rather than just speculative tokens. And just because something has more speculative use cases doesn't mean that it doesn't have any potential value. It just means the risk reward is different. And that doesn't mean you can't own it. For some people, it means maybe you shouldn't own it if you have a different risk profile or you have a different view on the potential, positive outcomes for those use cases. But for an investor looking at it to say, hey, there's potentially a lot of use cases that could emerge, just because it's speculative doesn't mean that it's uninvestable.
That's right. I would just add, yeah, it's a new computing platform. And just like other computing platforms, whether that was mainframes or early days of PC or cloud computing or mobile, it's not clear initially what all the use cases are, but you could point to the characteristics that this new decentralized platform can have. It can move money around the world. It can program money like software. And you are seeing real world use cases of this. It's not all just circular within crypto. I'd point to Nike, which did $185 million in NFT related revenue. Now, people may joke about that. They may say, well, why is someone buying a digital sneaker? But it's often kids who are bringing them into video games and want to show off in a digital world. That's a real world use case. I mentioned PayPal launching a stablecoin. If you have time, look at the PayPal stablecoin homepage. It says built for payments. This is the largest fintech company in the world putting its flag in the ground, saying that the future of payments is on stablecoins, so much so that they're willing to launch one into an uncertain regulatory environment. And I think you're seeing people figure out these use cases. Some are inside crypto. You have Uniswap, which is an app built on Ethereum that's doing billions of dollars in trading volume every month with no CEO, no offices, no physical state, almost as much, sometimes more trading volume than Coinbase. These are real world use cases that are emerging, and that's the core driver of the economics. The reason it's not a Ponzi scheme is people are building useful things on Ethereum, and other people are using those things and paying a fee to use them, just like, as you mentioned, in any traditional app store with Uber or Lyft or Airbnb, et cetera.
Yeah, excellent. All right, Steve, I think we have time for one more yet.
Okay, great. Thanks. Let's just a bit more educational. I think you guys touched on this, and certainly in the paper. For this self-identified newbie, can you explain what the burn is? And we also got some questions around supply cap in comparison to the hard supply of Bitcoin. So maybe kind of around that territory of burn and supply.
Yeah, we touched on it a little bit. I'll pass this one to Matt to give a good overview of what exactly is the burn, what does it do, how does it work?
Yeah, sure. So if you think of all the Ethereum that's been issued today, it's like 120 million ETH. That's what exists today. When you want to do a transaction in Ethereum, you have to pay a fee in order for your transaction to be processed. Let's imagine it's $2 or $5 or $10. A significant portion of that fee, it depends on how congested the network is, but a significant portion of that fee, let's say 6 out of your $10 or 7 out of your $10 worth of ETH is burnt. You can think of it as just disappearing forever. We threw up that chart earlier about the amount of Ethereum actually falling. I suspect we've hit peak ETH. So we talked about peak oil. That turned out to be wrong, but I suspect we've hit the point where there's we've hit the maximum amount of Ethereum that will ever exist, because as more people want to use the network, more of this Ethereum is burned. You can think of there being almost a very limited supply of oil. Every time you drive your car, some of it is burned and gone forever. The way the Ethereum supply works, a little bit of Ethereum gets issued every year. Right now, it's about 1%, could vary over time, but then you have to deduct based on this use burning Ethereum. And right now it's burning maybe 1.5% of Ethereum each year. So the supply is going down.
Excellent answers. All right. I think that's all the time we have today. Thank you all for your time and being with us today. Special thanks to Matt Hougan of Bitwise. If we want to put up the slide for our research, if you want to see more of our industry-leading research, go to fidelitydigitalassets.com/research, or you can just scan that handy little QR code that you see on your screen with your mobile device, and be sure to sign up to get all of our latest research sent to you. Also check out Bitwise Research, I mentioned before, is also very good. We make all of our research free, open. It's on the website, so feel free to look at it, including this paper that we talked about. I'll wrap in a plug for a upcoming little piece of research that we'll have out soon on layer twos and fees on the network, because someone did ask a question I saw about whether these layer twos that Matt talked about, they're cheaper to transact on. So if people move to layer twos, will that actually decrease the fees for the Ethereum base network? And is that a concern? Spoiler alert, we don't know yet, but we try to be intellectually honest in all of our research. So we've got a great piece coming out by Max on that will address that and educate people on there. So that's it for us today. Thank you again so much for joining the Value Exchange, and we hope to see you again in a future Value Exchange.